The market is open, and Amazon.com Inc. is currently trading at $256.76, reflecting a significant intraday gain of approximately 5.13%. This follows the colossal jump we saw after their latest earnings report, which fundamentally shifted the narrative around this stock. Now, the common expectation has been that Amazon is a slow-growth giant, a value play within the tech sector that you hold for stability, driven primarily by the slow but steady compounding of its retail dominance and the reliable, if decelerating, cloud behemoth that is Amazon Web Services, or AWS. The market has been treating it less like an aggressor and more like a utility, particularly after the past year's choppiness, where rising interest rates and macroeconomic uncertainty squeezed their margins and caused investors to question the company's capital expenditure strategy. This latest intraday surge, however, is a direct result of a deeper reality. Amazon is showing signs that it's not just stable, but has found a new source of acceleration, one that Wall Street did not fully bake into its models. The surprising element isn't just that AWS growth has re-accelerated. That was somewhat expected to a degree, but the sheer force of the cost efficiency and the burgeoning high-margin advertising business running at full tilt alongside the retail recovery. That combination is the true unexpected insight. It suggests that the company's recent brutal focus on operational efficiency, which included significant layoffs and trimming down excess capacity across its logistics network, is translating into margin expansion much faster than skeptics believed. This is not just a return to baseline. This is a structurally leaner, more profitable Amazon. Now, let's establish common ground. The general belief, the baseline expectation for Amazon stock, hinges on two main pillars: retail dominance and cloud profit, meaning AWS. Everyone knows the retail segment is massive, serving as the default online shopping option for millions, a place where you can find practically anything and have it delivered with increasing speed, thanks to Prime and its aggressive expansion of same-day and next-day delivery capabilities. It's the engine of revenue scale. Then you have AWS, which everyone rightly views as the crown jewel, the high-margin segment that has traditionally funded every new venture and every investment, acting as the primary source of operating profit. The tension, the central question that has been challenging investors recently, is whether AWS can maintain its leadership and margin power in the face of massive and aggressive competition from rivals like Microsoft and Google, especially in the capital-intensive and rapidly evolving field of generative artificial intelligence, and whether the retail side could ever become truly profitable in a material way, given the crushing costs of building out a global logistics network. The contrarian take we need to consider, and what the recent price action supports, is that the narrative is shifting from a retail cloud duopoly to a powerful, high-margin triumvirate: cloud, AWS, advertising, and an intensely optimized retail core. The market is just beginning to price in the profit potential of the advertising segment, which leverages Amazon's unparalleled consumer data and placement on the retail platform to create a truly formidable, high-margin, scaled ad business that few companies outside of Alphabet or Meta can compete with. This pivot is forcing a rethink of the core valuation. Looking at the most recent stock movement, the catalyst has been undeniable: the latest earnings release. The stock's reaction has been violent, in the best possible way, seeing a massive surge in trading volume as institutional desks moved quickly to re-rate the stock. The key figure that blew expectations out of the water wasn't the top-line revenue, which was strong at over $180 billion, but the accelerating growth in AWS, coming in at a strong 20% year-over-year growth, which represents its fastest acceleration in nearly 3 years. That statistic alone is what flipped the AI narrative positive, as some analysts have put it. Concerns that AWS was losing ground or was too slow to react to the generative AI infrastructure build-out have been at least temporarily quelled. But the deeper detail in the report was the strength of the advertising business, which posted a remarkable 24% growth, showcasing its potential to become the third leg of the profit stool. This kind of simultaneous acceleration in multiple high-margin segments is the kind of signal that re-energizes large institutional holdings and gets the attention of money managers who use services like Fidelity's trading platforms or the sophisticated tools offered by Interactive Brokers. High trading volumes post-earnings show that smart money is quickly increasing positions, betting on a sustained acceleration rather than a one-off beat. Individual investors using online investing apps like Robinhood or automated tools like Schwab Intelligent Portfolios will be noticing this major upward trajectory and the general bullish sentiment echoing across financial news feeds. The stock is currently testing its 52-week high, a clear sign of powerful upward momentum driven by this fundamental news. To understand the full picture, a brief look at the foundational business is necessary. Amazon is split primarily into three major segments: North America, which is e-commerce, International, which is also e-commerce, and AWS, or cloud services. The core of Amazon's operation, the North American and international retail arms, are logistics and consumer convenience masterpieces. The company's business model is fundamentally based on a high-volume, low-margin retail operation, subsidized and profit-driven by the highly profitable AWS. AWS provides on-demand cloud computing platforms and APIs to individuals, companies, and governments, and is the global market leader in public cloud infrastructure, providing compute, storage, database, and machine learning services. Its sheer scale and the sticky nature of its enterprise contracts, often secured by long-term backlogs, provide a massive and reliable cash flow, making it the bedrock of Amazon's financial stability. Historically, every time Amazon stock has seen a major downturn, it has been a question mark over either the spending on the retail network or a deceleration in AWS. Recent history, from the post-pandemic cooldown to the macroeconomic pressures of rising interest rates, saw the company's focus turn laser-sharp to efficiency, and that is what we are seeing bear fruit now. The old reports from last year painted a picture of a company with bloated infrastructure and excessive spending. The new reports, however, paint the picture of a company that has successfully right-sized while simultaneously ramping up its highest margin growth engines. Now, let's shift to the future outlook, which is where the real tension between expectation and reality comes to a head. The immediate future for Amazon is tied to the upcoming holiday quarter and, more significantly, to its capital expenditure plan. Management has signaled a willingness to ramp up capital spending for the future, particularly in AI infrastructure and data center capacity for AWS. This would normally cause some investor anxiety, as increased CapEx weighs on short-term profits and free cash flow. However, the market's reaction to this news has been overwhelmingly positive this time. The expectation is that high spending is a necessity to maintain AWS's market leadership against rivals and capitalize on the massive tailwind of the AI investment cycle, which is driving demand for services like high-performance computing, data storage, and custom AI chips like their Trainium and Inferentia series. The reality is that investors are now seeing this spending as an investment in a higher growth and higher margin future, rather than an active, retail-fueled recklessness. The new expectation is that this spending will solidify Amazon's position as a top-tier provider for the new AI workload, giving them a durable competitive advantage. The main catalysts that could sustain this momentum are a continued acceleration in AWS growth, a greater than expected margin realization from the advertising business as it expands into Prime Video and other platforms, and stable to improving profitability in the North American retail segment as the company fully benefits from its regionalized fulfillment network, which dramatically cuts down on middle-mile costs. On the risk side, the primary threat is a renewed slowdown in corporate cloud spending, perhaps due to a tougher economic environment or intensified price competition from other major cloud players. We can also not discount regulatory risk, especially with the company's size and market dominance, which is a perpetual shadow over any big tech name. However, the current momentum suggests that the operational tailwinds are strong enough to power through moderate headwinds. The narrative of Amazon being a capital-heavy retail business dragging down its high-margin cloud profit engine is clearly outdated. The new reality is a focused, efficient giant with two high-growth, high-margin engines firing in concert with a much leaner and more optimized retail foundation. This new structural efficiency is what has the market so excited and why the stock price is behaving the way it is. The conversation around where to hold this stock is also evolving. While many still favor a traditional broker for their core holdings, the rise of specialized investing sites and mobile-first platforms has made it easier than ever for the individual investor to participate. Whether you use a platform like Fidelity for its research and stability, or perhaps a more modern service from SoFi Invest or even Robinhood for quick access to fractional shares, the availability of online investment has leveled the playing field. For those who want investment help but prefer a hands-off approach, an intelligent portfolio like Schwab Intelligent